Let's get back to East Africa. Political risk is a bit of a theme, as you might notice in this bulletin. A case involving the Kenyan president at the International Criminal Court at The Hague is possibly one of the biggest economic risks facing East Africa's largest economy. Uhuru Kenyatta opted to attend the hearing as a citizen, at least in the legal sense, by temporarily handing over power to his deputy, William Ruto. But investors are still concerned about any unforeseen outcomes. The research firm StratLink Africa points out that political risk and a weak, tense devolution process are key threats to Kenya's economic climate. Now, the firm's October Outlook report also points out fears of a slowdown in business activity if the country does hold a referendum. Why is that? Well, historically, periods of intense political activity in Kenya often have a very strong correlation with the decline in economic output. The same report also warns of potential political risk in Tanzania, well ahead of its general elections in October 2015. Let's go over these risks in a bit more detail. Julian Mboko is an analyst with StratLink Africa. He's with me in studio right now. Thank you for your time.
Thank you for having me.
The rebasing exercise, we spoke about this last week. It essentially reduced our tax revenue to GDP ratio to about 20%.
Yes.
And in the report, you guys argued that this essentially implies there's a lot more room for the expansion of the tax net. Where are the opportunities for GOK?
I think if you look at the key areas that drove the rebasing exercise, manufacturing, real estate, to be very particular. But more importantly, when it comes to discussion of revenue from the Kenyan perspective, it's important we understand this from the fiscal policy mix. The government has been less concerned about beefing up the tax net and more concerned about fiscal consolidation. Yeah, we've seen so much talk about the wage bill, for instance, and we've seen also the president and the deputy taking up tax cuts, rather salary cuts, on their parts. So Kenya's position at the moment is more on fiscal consolidation, a conservative fiscal policy, which will be more driven towards beefing up the revenue on the government side. And more importantly, because if they now move to the taxes again, the pressure on inflation could actually now come into play.
But wouldn't it be fair to argue, at least from an investor's perspective, or even a taxpayer's perspective, that GOK tends to talk, but that doesn't always match what it actually does? If you look at borrowing, for example, in the last fiscal year, they said they want to borrow 106 billion, they ended up borrowing almost twice as much. So the fiscal consolidation argument really doesn't wash in the sense that we've never actually seen any serious cuts in government spending.
Well, in this particular sense, I think we are beginning to see signs that the government could actually be walking its talk, in the sense that there's an audit underway right now. And if you look at, for instance, what the Auditor General tells us about the ghost workers, Kenya loses an approximately 2 billion shillings to ghost workers every year. If you look at that sum, that is exactly what we allocate to the Agribusiness Fund, which is supposed to help farmers access credit. Now, agriculture is about 25% of GDP. 75% of Kenya's workers are actually involved directly or indirectly in the sector. Now, if you look at the measures being taken, I think the government is becoming increasingly serious about fiscal consolidation.
All right. Moving on to the question of political risk, specifically with regard to the referendum calls. There's a dispute now between the central government, who says, no, you can't have more money, and the county governments that are saying, you guys are wasting cash at the central government level, give it to us, we're better placed to spend it. From an investor's perspective, what's the political risk there?
When you look at the tug of war between whether or not to have the referendum, I think historically, as we have pointed out in our monthly issue, we tend to have a slowdown in investment and business during electioneering cycles. And that is what is likely to happen if we ended up in a referendum position. But look at it from the flip side now. I think Kenya's political risk has largely been priced in by investors. If the Eurobond is anything to go by, 500% oversubscription in light of a really tense security environment.
But can we really say that, in the sense that, if you're an American investor, you're sitting at JP Morgan Chase or whatever in New York, and you're looking at negative yields or 200 basis points of yield in Europe and in the United States. If someone comes to you and says, we'll give you 800 BP yield over in sub-Saharan Africa, it's a no-brainer.
It certainly is an incentive. But if you look at the political dynamics within the country, first of all, we're seeing a bit of rising of temperatures, but not in levels that we would say are stoking a lot of concern from the investor's point of view. We would be concerned if the incidences we have seen indicative of intolerance between the two sides protract. Then in that case, we could see a lot more caution being taken by investors. But otherwise, we believe that a lot of pricing in has been done because Kenya, the fundamentals macroeconomically are sound.
All right, final question to you with regard to Tanzania. It goes to the polls next in October, and you've described, I'm quoting here, the elections might be a potentially bruising contest. Why?
Because if you look at Tanzania's election history, the largest margin by CCM, by the Chama Cha Mapinduzi.
That's the current ruling party.
Yes, was won in 2005. And that is when we had the largest number of parties contesting for the presidential seat. But here we have a scenario whereby, in light of the stalemated constitutional review process, 3 factions, and we would argue very considerable factions, have said they will field one candidate. Now, the last time we had a replay of this scenario was in '95, and that is when the CCM had the least margin of victory. So we believe that...
about 60% of votes or something like that.
Yeah, 60% of the votes cast for the presidency. And therefore, in this regard, we believe that actually CCM, and with due regard to the fact that the incumbent president won't be eligible again, is likely to face a heated contest.
Indeed, we'll have to leave it there, unfortunately, but thank you for your time as always.
Thank you.
Julian Walker there from StratLink Africa with us in studio, going over the economic outlook and the economic status health check, if you will, of Kenya and Tanzania.